This week, the yield on the 30-year United States Treasury bond climbed to its highest level in 19 years. If part of your retirement plan sits in bonds, the kind of holding most people were told for decades is the safe, boring, reliable part of a portfolio. I need to walk you through what a move like this actually does to that holding, because the mechanism is widely misunderstood, and it is working against a lot of retirement accounts right now, in a way most of the people holding them do not fully realize. Here is the twist, and I am giving it to you immediately instead of making you wait. When bond yields rise, the price of bonds you already own falls, and it falls immediately, not eventually. This is not a delayed effect or a future risk. It is happening right now, today, to every existing long-term bond sitting in a retirement account anywhere in the country, and a 19-year high in yields on the longest dated, most rate-sensitive government bond available means the bonds most affected by this move are specifically the ones many retirees were told to lean on hardest for stability. Before I go further, I want to know who is with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly whether you know off the top of your head how much of your own retirement savings currently sits in bonds versus other assets. I read these, and I promise you the pattern in the comments under a video like this always reveals how few people have actually checked that specific number for themselves. Let me explain the actual mechanism, because understanding it clearly changes how you read every headline about rising yields from here forward. A bond is essentially a loan you make to a borrower, in this case the United States government, in exchange for a fixed interest payment over a set period of time. When that bond was issued, it carried a specific interest rate that reflected market conditions at the time. If new bonds start being issued at meaningfully higher interest rates, the older bond you already hold, paying its original lower rate, becomes less attractive by comparison, because anyone buying it on the open market today could instead buy a brand new bond paying more. To make that older bond worth actually purchasing, its price has to fall until its effective yield roughly matches what new bonds are offering. That is the entire mechanism in a sentence. Rising yields on new bonds mean falling prices on the older bonds already sitting in portfolios everywhere. And the longer the maturity of the bond, the larger that price swing tends to be for any given change in yield. A 30-year bond, the longest maturity commonly held, is specifically the most sensitive to exactly this kind of move, which is precisely why a 19-year high in this specific yield deserves your attention. If you are finding this useful already, take a moment to like this video and subscribe, because the next part explains why yields are spiking in the first place, and it connects directly to concerns that have been building across multiple threads I have covered in recent videos. Here is why this is happening right now. Yields have been climbing amid growing concerns over the sheer scale of government spending and persistent inflationary pressure. Concerns that have been building for months as the nation's debt and its annual interest costs continue climbing. And this is not an isolated American story. Sovereign bond yields across other major economies have also climbed to their highest levels in decades. This same week, suggesting this is a broader global reassessment of how much investors are willing to pay to hold long-term government debt, not simply a single country-specific concern. Layered on top of that fiscal pressure, oil prices have been climbing as well, with hopes for a renewed agreement between the United States and Iran over the Strait of Hormuz, dimming further this week after President Trump stated plainly that he is not interested in extending the interim deal that had provided some temporary relief earlier this year. Elevated oil feeds directly into inflation concerns, which feeds directly into the kind of yield pressure driving bond prices lower right now. Here is the detail that I think deserves the most attention of everything in this video. Rising yields are, in the textbook relationship, supposed to be bad for gold because gold pays no interest at all. And when bonds start offering meaningfully higher yields, the opportunity cost of holding a non-yielding asset like gold rises alongside them. And yet, even with the 30-year yield at a 19-year high this week, gold has pulled back only modestly, trading below $4,350 after a roughly 2% dip in the prior session. Still up close to 30% over the past year and up more than 8% in just the past month alone. A textbook headwind this significant should, by the old playbook, be producing a much larger decline than what has actually shown up. Gold continuing to benefit from strong investment demand and ongoing central bank purchases, particularly from China, appears to be absorbing a real portion of the pressure that a yield spike this size would normally be expected to inflict. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither is real. But both are the kind of person you might recognize. The first I will call Ambrose, 73, who has a meaningful share of his retirement savings in long-term government bonds, following advice he received years ago that bonds represent the safe, stable anchor of a well-built retirement portfolio. He has not looked closely at his account statement in recent weeks and has no real sense that this specific holding, the one he has always considered the least risky part of his entire plan, has actually been losing real value as yields have climbed, simply because he has never connected the headline about rising yields to what it actually does to a bond he already owns. The second person I will call Cordelia, 69, and she understood the mechanism clearly enough to actually check her own bond holdings when she started seeing headlines about yields climbing to multi-decade highs. She confirmed that the specific long-duration bonds in her own account had indeed lost real value as this move unfolded. Not a catastrophic amount, but a real, measurable decline in exactly the part of her portfolio she had always been told to think of as the boring, stable piece. Understanding that clearly did not cause her to panic. It simply meant she was not confused or blindsided the way Ambrose currently is, sitting on a real loss in his safest holding without any framework for why it happened. The difference between them was never how much either one had saved. It was that one of them understood that safe and immune to loss are not actually the same thing when it comes to long-duration bonds. And one of them had never had that distinction explained clearly enough to check for himself. Now, why do so many careful, intelligent people end up like Ambrose, assuming the word safe attached to a bond means immune to any meaningful loss? There is a simple, well-documented reason. Bonds genuinely are safer than stocks in one very specific sense. The government is extremely unlikely to simply fail to pay you back the principal at maturity. That specific kind of safety protection against default gets generalized in most people's minds into a broader sense of safety, protection against any kind of loss whatsoever, when in reality a long-duration bond sold before maturity can absolutely lose real, meaningful value if yields move against it, exactly as they have this week. The investors who navigate a week like this one calmly are rarely the ones with a more sophisticated understanding of bonds. In some abstract sense, they are simply the ones who understood ahead of time that safe from default and safe from any price movement are two genuinely different kinds of protection, not one single guarantee. Now, let me be careful and honest with you, because I will not insult you with fear. And this exact subject draws people who want to frighten or excite you into a rushed decision. If you hold individual bonds to their actual maturity date rather than selling them early, you will still receive their full original face value, regardless of what happens to yields in the meantime, which means this kind of price movement matters enormously to anyone selling bonds early or holding bond funds that continuously roll over their holdings, and matters far less to someone who bought an individual bond specifically planning to hold it to maturity. It is also entirely possible yields ease back down from this 19-year high in the coming weeks. If inflation data cools or the Fed signals a clearer path forward, and gold's relative resilience this week does not guarantee it continues holding up if yields keep climbing from here. Anyone telling you this single week's move guarantees a specific outcome for either your bonds or your gold is overselling you a certainty that simply does not exist. What I am giving you is not a reason to abandon bonds, which remain a legitimate, valuable part of many well-built retirement plans. It is the actual mechanism connecting this week's headline to your own account. So you can check your own specific holdings with real understanding rather than either false alarm or false comfort. I want to say a word about silver here too, because it has moved somewhat differently than gold through this exact stretch. climbing above $66 and extending gains for a third straight session, supported by fading expectations for a near-term Fed rate hike alongside continued strong industrial demand from solar, electric vehicles, and data center infrastructure. That combination easing rate hike odds working in silver's favor, even as long-term yields climb for entirely separate fiscal reasons, is exactly the kind of nuance worth understanding, rather than assuming gold and silver always move for identical reasons at the same time. So let us pull this together and go back to where we started. The 30-year Treasury yield hit a 19-year high this week, driven by growing concern over government spending, persistent inflation, and fading hopes for a resolution to the Hormuz standoff after President Trump ruled out extending the interim deal. That move directly lowers the value of existing long-duration bonds sitting in retirement accounts across the country, a mechanism many holders of those bonds do not fully understand, even as it affects their own savings in real time. Gold, despite facing exactly the kind of headwind that textbook relationships say should hurt it significantly, has pulled back only modestly, continuing to draw support from strong investment demand and ongoing central bank buying. And the difference between the people who understand what is actually happening to their own bond holdings right now and the people who remain confused by a headline they never connected to their own account comes down to one thing: understanding that safe from default and safe from price movement are genuinely different guarantees. Here is what I want you to carry away from this, stated as plainly as I know how. This is not a call to abandon bonds, and it is not a call to panic about a single week's yield move, because balance and a real understanding of what you actually hold matter, far more than any single headline, especially with retirement savings. It is a call to check your own specific bond holdings, understand whether you are planning to hold them to maturity or not, and recognize that the word safe applied to any single asset almost always means safe from one specific kind of risk rather than immune from every kind of risk that exists. Whether any of this changes your own plan depends entirely on your own circumstances, your own timeline, and your own specific holdings. And I am not here to tell you the number. I am here to make sure you actually understand what this week's headline means. For the account you have spent years building. Do not let anyone use this week's yield move to rush you into a costly decision today, because there will be people trying in both directions, telling you either to panic out of bonds entirely or to dismiss this as meaningless noise. And do not dismiss it either. Telling yourself a headline about Treasury yields could not possibly matter to your own retirement account, because you just watched exactly how directly it affects the value of a holding a huge number of retirement plans were built specifically around. Those are two different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, the 30-year yield level, the current gold and silver prices, the recent percentage moves in each, comes directly from today's market reporting. So you can verify every word of it yourself rather than take mine. I opened by telling you that the safe part of your retirement account may have just taken a hit. Nobody explained to you clearly. Now you understand exactly why. A 19-year high in the yield that most directly affects long-duration bonds, driven by fiscal concern, persistent inflation, and a dimming outlook for peace in the Middle East, moving through portfolios in a way most holders of those bonds have never had explained to them in plain language. So let me leave you with the question underneath all of it. If the word safe has been doing more work in your own financial plan than it actually deserves, protecting you from one specific risk while leaving you exposed to another, you never fully understood how much do you actually know about what you are holding. And when was the last time you genuinely checked?